Hi, everyone, and welcome to today's webinar hosted by McClintock Associates. My name is Dave McClintock, and I will be your moderator. Before we begin, I'd like to thank everyone on this call for all you continue to do to support students. We've known that post-secondary institutions are resilient and resourceful, but your efforts over the past 8 months has demonstrated these features to a much broader audience. Thank you. Today's webinar will be covering the composite score, how it is impacted by lease accounting changes, and also how the borrower defense to repayment regulations that went into effect July 1st will have an impact. We will also cover accounting and financial reporting guidance for the CARES Act. We are sharing this guidance as part of our vision to be the thought leader providing consulting and compliance solutions to post-secondary institutions so schools can focus on changing their students' lives. Before we begin, we do have a few housekeeping items to cover. First, the tool you are currently using is completely interactive. Please feel free to ask questions right within the widget in your viewing panel in the upper left-hand corner of your screen. Please also see the resource section where today's slides and other relevant documents are available to you. We do anticipate a lot of questions today, so please know that we will be actively organizing them as they come through. If some questions can be wrapped into one, we will likely combine them. We will address as many questions as possible during and at the end of the presentation. We will also be recording the webinar today, and the file will be made available in the next few days to all who attended. Our presenters today are Mike Weary, a director at McClintock Associates, and Jennifer DeBoer, a senior manager at McClintock Associates as well. Both presenters provide consultative solutions for post-secondary institutions and have deep, comprehensive experience in this unique industry. We strive to provide helpful information to Title IV schools via our McClintock Minute blog and through posting on Facebook and LinkedIn. To receive our updates, you can sign up on our website and/or follow us on Facebook or LinkedIn. Because there have been so many updates required by COVID-19, we have created a category on the McClintock Minute page where you can see everything related specifically to the pandemic. In addition, we have created a variety of other resources, such as webinar recordings and infographics that schools might find useful. These can be accessed using the website address provided on slide 6. And with that, I will turn things over to Jen, who will walk us through the outline of today's presentation and then get started with the overview of the composite score.
Hi. Go ahead.
No, go ahead, Jen. Go ahead, Jen.
I was going to say, today we're going to talk about the timeline in the composite score, as well as the financial responsibility standard changes and the CARES Act as well. And we will finalize with some planning items after we go through those changes. So Mike will begin by talking about the composite score.
Thanks, Dave, and thanks, Jen. It's a pleasure to be working with both of you on this webinar again. And also to thank everyone for joining today. I'm sure there's other current news that's a higher priority that you may want to hear than going through accounting and composite score ratios, but it's also the focus of things we just need to work on right now and to be prepared for year end. So so thanks for taking the time to join us. One of the things we're going to talk briefly about, the what is the financial responsibility standard changes and how the CARES Act relief ties into that, and the why is outlined. I just wanted to kind of give a brief overview of how we got here. So the composite score was initially issued back in 1997, and as I was preparing for this, it shows how long ago that was. It's the year Princess Diana died. It was the year the first Harry Potter book came out, and it's the year Hong Kong reverted back to China, which to me are things that just seem so long ago. And so it shows how long we've been working with the composite score. The accounting standard boards then issued a accounting standard update called 2016-02 that addressed the treatment of leases. This was a broad project trying to get U.S. accounting standards to converge with international accounting standards. And we're not going to get into those details today, but basically they finally came to some resolution, and they're going to record all the leases on your balance sheet as if you bought those leases. And so because that happened after the composite score was issued, at some point, the Department of Ed had to change the composite score to account for this. And so they did that via the borrower defense to repayment regulations, which really, I don't think BDTR was designed necessarily for the composite score. That wasn't why they wrote those rules. But because the 2016 borrower defense repayment regulations had the financial triggers put in there for financial responsibility, this seemed to be a good vehicle to get the composite score fixed for this lease correction that they had to make changes or to adapt it for. And so it just seemed to be the department wasn't willing to tackle, and they didn't have the time to tackle a full work over the composite score ratios. So they put it as part of BDTR, which did come out then September 23rd, 2019. The FASB has delayed the effective date of 2016-02, the lease standard, twice. Once because there were just a lot of projects going on, and they felt that companies just needed more time to implement it. And then they delayed it again because of COVID. So realistically, for a 12/31 year-end client, the lease standard is not going to become effective until 12/31/2022. But again, you need to start knowing the impact of it now. And of course, the new composite score ratio as part of the borrower defense rules became effective July 1st, 2020. So that's kind of the timeline just to how we got to where we are today. As I mentioned, the Department of Ed had to change the composite score for this lease impact, and we're going to go through some of the details. At the same time, though, that they also wanted to address treatment of long-term debt in the primary reserve ratio. There was a lot of pushback from the OIG and from other groups that the debt was not being used in the primary reserve ratio as the original intent of the regulations. One of the allegations was Corinthians, for example, was borrowing long-term debt that was restricted, and which improved their composite score ratio. But that cash they got on it was restricted. So it was really not debt they were getting to use and invest in the school. It was just debt they were borrowing and paying off, but getting an advantageous effect in the CSR, which by the letter of the law was allowable, but it was against the intent, I think is what the Department of Ed felt. So they wanted to make changes for how long-term debt is treated in the composite score. There were a couple other items that really affected nonprofits more. They wanted to change how net investment gain or losses are treated in the composite score, along with defined benefit pension liabilities. I'm not going to get into those today. Both of those changes were preferential. They were the benefit of all institutions. It's just mainly going to affect nonprofit institutions more. And then the big thing I want to point out is ED issued a Q&A, came out in April 9th, and ourselves and along with some other CPA firms and lawyers, along with other groups like NACUBO, sent questions into Department of Ed last fall regarding the new borrower defense repayment rules. And this Q&A is about, if it's 20 pages, can't remember exactly how long, but it's really critical that you go through it in detail. They have lots of examples, lots of specific questions, and it's really important, as you'll see, to look at that Q&A as you're evaluating your composite score ratio. Before we get in, just a couple quick reminders. The composite score ratio has three components: the primary reserve, which is measuring liquidity. It's kind of looking at your next operating cycle if you've got good liquidity to make it through. An equity ratio, which measures how well your return on assets and your ability to borrow is. And then that income ratio that measures profitability. As we'll see, I'm going to show what a couple of the ratios look like. The biggest driver is equity, with the second driver probably being revenue or your net income. But the ratios are structured that you could max out the primary reserve and the equity ratio while completely failing the net income ratio and still pass. You'd have a score of 1.8 if you're for-profit or 2.2 if a nonprofit, because the weightings are slightly different. And so the advantage of that is you can have a couple bad years as long as your equity or net assets are strong, and that's how the ratios are designed, which in some ways makes a lot of sense. So what I'm showing here is our old template. I want to be very clear. You're going to see later on that these templates I'm showing here we're no longer using because of the new rules. But just for the sake of discussion, though, to point out, you'll see this is a ratio of equity basically over expenses. You'll see how property, plant, and equipment is a reduction of that equity, while long-term debt is allowed to be an add back up to the amount of net PP&E. And this ratio maxes out if your numerator is at least 15% of the denominator. So that's one of the triggers you want to work for. And then the next ratio, the equity ratio, again, it's a ratio of what they call modified equity to modified assets, where you're taking your equity and assets and just subtracting a couple items. And this ratio maxes out at 50% if your numerator is 50% of your modified assets. The last ratio I'm not showing, because it doesn't really change under the new composite scores, is just a net income ratio that is net income over revenue. And for a for-profit school, that maxes out at 6% and 4% for a non-profit school. So I just wanted to show these charts in here to kind of give a quick reminder of how the composite scores work and as is before we get through, before we start looking at the new changes that are coming. And for some of you are now in existence. So at that point, I'm going to turn it back to Jen, and she's going to talk about the lease accounting changes, and then it'll come back to me to talk about the changes for debt.
So moving on to the lease accounting changes for the composite score, the FASB issued ASU 2016-02 that requires an entity to record an asset and liability for its lease assets on the balance sheet. So the department said, okay, we have to address this change. How do we do that? And where they landed was they decided to compute one score and grandfather all leases prior to December 15th, 2018. They selected that date because that was the original date that the standard was effective for public companies. So what that means by grandfathering is all leases entered into prior to December 15th, 2018 are considered pre-implementation leases, and they would be excluded from the composite score. One thing to note though, this would only be applicable for when your institution would adopt the standard. So Mike mentioned that earlier, that the private institutions have not yet been required to adopt this until the year ended December 31st, 2022. So for those leases entered into after that date, they're all considered post-implementation leases. So that's leases that are signed, renewed, or extended. So how that is included in the composite score then is the right to use asset that's put on the balance sheet will be treated as PP&E in the composite score. And then the lease liability that is on the balance sheet will be treated as long-term debt. And the impact this has on the composite score is mainly to the equity ratio. And that's because that total asset number that's in the denominator. And we'll see that in the next example. So here's a simplified example of the composite score impact. We took this footnote from the financial statements. It's the lease commitment footnote. And we took all the future commitments for the next 5 years and thereafter. We present valued those leases because that's required in the standard, and that's present value by the borrower's discount rate, most likely. And what we're showing here is how the standard would impact the balance sheet. So you'll see on the left, there's a new category called right to use asset, and it's listed on there for $21.1 million. And then further down, you'll see the lease liability for the $21.1 million. The income statement does not have an impact, and you can see that off to the right. So when looking at the composite score and the calculation and taking these new assets and liabilities into consideration, you'll see that total assets under the new standard column is now 51.6 million. So that went up significantly. And off to the right, we have the before and after scores. So the column where you see the green pass, that is pre-standard, pre-composite score change. And you'll notice that the equity strength factor score is what really is driving that change. And when taking into consideration the new standard, you'll see that that particular factor declined. So it took, in this example, an institution from being passing into the zone. And generally speaking, the primary reserve ratio is not really impacted by this change because the add back is limited. But as shown on the other page, the biggest driver of the decline in the ratio would be the equity ratio. And one thing to note is an institution can elect not to grandfather those pre-implementation leases. But once they do that, they cannot go back and unelect that option. So you just want to make sure that once you make that election, you're confident that that is the right decision to make. And again, it still would not be effective until you adopt that lease standard as a private institution. And one last note on the bottom here is there are some nuances related to the renewal options and change in ownership. So I would refer back to the Q&A for any details related to that.
And Jen, just one comment. I'm not aware of any of our clients that have adopted the lease standard early. We don't see really any benefit of doing that. It's obviously more accounting work you have to do to get all the leases on your balance sheet and also the composite score impact. So there's really not any benefit to wanting to early adopt the accounting standard.
So another thing that we did was we did a lease impact study. And we took our client base and looked at 2019 year-end numbers. And we put some assumptions and inputs into this study. We assumed a 6% interest rate, and then we looked at the financial statements to pull the lease commitment, not really looking at the leases in detail, but using those summarized numbers. And what we saw here is that there is a impact to the composite score. On the left-hand side, there's the pre-lease numbers and then the post-lease impact. And on average, all schools declined about 0.19 in their ratio. So then another thing that we did was we excluded all the schools with a zero change to pull them out, and the average increased to 0.30. And the largest swing that we saw, because in the prior slide I should have mentioned this, the high swing that we saw was 1.0. So it could be significant for your school. And that largest swing was in a small school, below total assets and a long lease. So it's really a function of math there. We had 42 schools in the projection, excluding the zero change, 32 were in that second part. And the last thing that we did was we looked at the schools that were not passing in that current year. And then after the change, those that then went into that bracket of under 1.5. And as you can see here, it almost doubled the number. So if your institution is really close to that 1.5 number, you're going to want to do projections and really look at this. It is a few years out if you're not adopting the standard, but you might want to start projecting that. So now I'm going to hand it back over to Mike to talk about the debt changes in relation to the composite score.
Thanks, Jen. And just to add a couple points on to what Jen was going through, when we did the lease analysis internally, we assumed all leases were going into the composite score. So we weren't breaking out pre-implementation, post-implementation leases. We had kind of done that under call it the old composite score standard, just to see the overall impact. We also didn't model on any of the debt changes I'm going through. So I think it's really important to look at your schools, whether the lease makes a change or not, because I think the better number is if the lease does have an impact on your ratios, it's more likely that 0.3 number, not the 0.19, because it goes back to how much equity a lot of schools have. So if it is moving your number, it's more likely to move at 0.3. So if you're at a, say, 2.0, start thinking that maybe the number could be for you a 1.7. Now we're going to go through the debt changes, which could also make an impact. So I think each of these things, it's a compounding effect now of two things that could possibly now start pushing it to a change of 0.5, which is a fairly big swing on a composite score that maxes out at 3. It's 60% of that number. So we're going to talk about some of the debt changes, and again, a lot of this goes back to what department felt the original intent of the regulation was. So what we took away from reading the regulations and from talking to some people that were on the subcommittee for bar defense repayment, the financial responsibility subcommittee that kind of looked at this, was they felt department really wanted that all long-term debt should be treated the same. So whether it's a long-term permanent debt, we'll call it term debt, just 5-7-year debt, or a long-term line of credit, department didn't see any difference as long as it was for long-term purposes. And they really believes that the debt must be tied to investment in property, plant, and equipment and not used for operations to get the beneficial treatment in the composite score ratio in that primary reserve. So they're reverting back to the original intent. And on my overview slide at the beginning, you'll see that I have included in there Dear Colleague Gen 0308, which came out in 2003. Department pushed this issue that long-term debt had to be tied to an investment in PP&E with a year or two after the composite scores initially came out. There was pushback on that, and department ended up relenting. And so when they issued Dear Colleague letter Gen 0308, they basically said, hey, any long-term debt can be treated positively in the composite score ratio. Well, by these new rules, they basically repealed that and said it has to be tied to PP&E, that this debt has to be tied to the investment in the school, and if it can't just be used for operations. Now, we're going to go through some examples to show you what that looks like. Department, like the leases, did acknowledge that, hey, your financials have been baked in. These regulations, while they were talked about, they didn't become final until September of 19, and we're going to be effective then, of course, in July of 20, based on the master calendar. So they allowed some phase-in as necessary. So what they've defined, kind of like the leases, they've defined pre-implementation PP&E and debt and post-implementation PP&E and debt. So now we have a number of different terms and numbers we're going to have to start tracking. What department said was the PP&E and long-term debt that is included on the last audited financial statement submitted and accepted prior to June 30th is your pre-implementation debt. That's right from the statute. So those statements that you submitted and assume they're accepted before June 30th, 20 are going to memorialize what those pre-implementation PP&E and long-term debt numbers are, which for many of you, and I'm going to use the 1231 statements just for sake of discussion today. So for many of you, that'll be 1231.19. However, if you did not submit your financial statements before July 1st because of the COVID extension, department is now saying that you're subject to the new rules. So your last audit submitted before June 30th, 2020 is going to be your 1231.18 financial statements. This issue has been taken to ED about whether some relief will be provided on that. But at this point, that's unknown, and I would go on the assumption that if you did take advantage of the extension, your pre-implementation numbers will be 1231.18. And if something changes on that, department will publish something, or we'll let the community know, certainly. So what the department has said is if you have qualified debt, so that would be your pre-implementation debt, or your post-implementation debt, if it's qualified, it's allowed to be treated as an add back in the primary reserve ratio. So our goal is to be certain your debt is deemed to be qualified, because if it's not qualified, then you're not going to get the preferential treatment in the primary reserve ratio. In essence, and to be qualified and preferential treatment will be treated as the debt is now, consistent with how it currently is. They did acquiesce on one item, that if you have short-term financing for construction in progress, and where we're really getting at is that, building of a new building, that type of construction loan, which we're getting at, that they'll allow that short-term financing to be an offset to that, to the construction in progress. And the reason is when you're building a big infrastructure project, that debt is usually short-term because it's a revolving loan for construction draws. And then it gets termed out when the project is done. So the intent of that debt is always to be long-term. It's not for operations, and it specifically ties to this, large investment in PP&E. So they acquiesce that that's allowable. Again, I think it's probably more likely that's going to affect nonprofit institutions than for-profits, where many of your facilities are leased. So let's talk a little bit about pre-implementation qualified debt. So what the department has said, and for sake of discussion today, I'm going to say 12/31/19 financial statements were completed and submitted prior to June 30th, 2020. So the debt that you had on those statements and the PP on those statements will be your pre-implementation amounts. That amount of pre-implementation debt can exceed the amount of pre-implementation PP&E, just kind of as the rules are now. That debt can never go up, because remember, this is a grandfather, and so this is, it's a temporary provision to allow the adoption of the new rules. So that qualified debt can never be increased. It can be refinanced. And you can change creditor as long as the dollar amount does not increase. And this is where the Q&A becomes really important. They have lots of examples and specifics on these type of items. So you have to read the Q&A closely. And it says, cannot be increased by any amount. So if it goes up by $1, we think that's tainted. So you kind of, as you start to do debt financing, to really understand what the impact is going to be. An extension of pre-implementation debt seems to be generally allowable, that if you just extend the term because maybe interest rates are more favorable, again, if the amount doesn't go up, that is allowed. And it also makes sense if you think of businesses with mortgages. Many of those are on a 30-year payment structure, but you have a balloon payment after 10 years. And the intent is to refinance that again after 10 years. So the department, I think, is understanding that just because you refinance this mortgage, you're not taking on more mortgage, you're just refinancing it as a normal business procedure, that pre-implementation debt continues to be qualified and treated as pre-implementation debt. Thinking through the ratios, the pre-implementation qualified debt cannot be used to offset post-implementation PP&E. So this is one of the big changes, and you're going to see later of how the department's going to want you to track this. So if I have debt that's pre-implementation for my 12/31/19 statements, it can continue to offset PP&E that was pre-implementation, but it can no longer be used to offset purchases from 2020 and in the future. So if your debt is higher, if your 12/31/19 debt is higher than your 12/31/19 PP&E, that difference that you're not adding back gets lost. It can't be used to help you against your 2020 property, plant, and equipment additions. In addition, related party debt appears to be disallowed. There's nothing in the regulations talking about related party debt, and the Q&A doesn't say specifically related party debt's not allowed, but it alludes to it in some of its answers. So it's not 100% clear, but I think if a related party debt, that's something really needs to be looked at, and it may take discussions offline to figure out how Department of Ed is going to treat that. If you have a long-term line of credit in a credit facility that you then term out over a longer period of time, that also appears to not taint it as pre-implementation qualified debt as long as it doesn't go up. And so you've just converted it to permanent debt. That seems to be okay. Again, it goes back to, did the debt increase or not? Because if it increases, then it's no longer treated as pre-implementation qualified debt. couple other things on the pre-implementation. Credit facilities have lots of specific guidance in the Q&A because there's usually line of credits and term debt combined in there. So I'm not going to go through those examples. Just got to have to look at it. They gave examples on the ordering rule, especially in a credit facility where you're paying off. The credit facility may have pre-implementation debt and may have post-implementation debt. So they give ordering rules as you make repayments of what debt gets paid off for the composite score ratio. For example, your pre-implementation debt is paid off first, and then you pay off your oldest post-implementation debt. I mean, it gets very nuanced, and you kind of have to just write down the numbers and fill out a chart and follow it through and apply to your circumstances. So that ordering rule becomes very critical. And of course, in a credit facility, any new drawdowns you're making at this point in time will now be post-implementation debt. And we're going to go through what post-implementation debt means as well. Again, make sure you look through the Q&A. Make sure you look at your specific debt and changes. I think before you make changes to figure out what's going to be the impact. Because what happens is once you've got post-implementation debt, which could be either new debt you're taking on now or pre-implementation debt that no longer qualifies, that debt must be tied to the acquisition of PP&E. So it no longer can just be in a general add back just because it's debt. Debt for operating purposes will no longer be qualified debt, and you don't get the beneficial treatment in the primary reserve ratio. So if it's short-term, short-term line of credits won't help you because it's not long-term. I've also seen lines of credit that may be long-term, but they are restricted for operating uses only. So I think if the agreement says this debt is only for operating purposes, then we can't tie it to the purchase of property, plant, and equipment, which means you get no benefit in the primary reserve ratio. And as we showed earlier, PP&E is a reduction of equity. So if you're reducing equity without an add back for it, that's a pretty sizable hit to your equity, unless your equity is really high. And so post-implementation debt must be tied to post-implementation PP&E. So if I have debt in fiscal year 2020 now, I have to prove how that long-term debt ties to the acquisition of PP&E. And we'll talk through we'll go through a couple examples a little bit, and the regulations don't say how specifically. There's some new footnote disclosures we'll go through, but it's not specific on its guidance. So a lot of it, I think, is going to come down to the school and the auditor to painting that picture of, say, how does this debt tie specifically to PP&E acquisitions? A couple other just general notes. Pre-implementation PP&E can only be decreased. Similar to the debt, it's grandfathered. It's a point in time. That number can never go up. It's the balance on your 12/31/19 statements, and it will go down each year by either depreciation or loss on disposal, or if you sell something, gain or loss on sale. But that number can never go up. It's like the debt. It's going to run itself out, and over a period of time, it's going to go away, and then everything will be post-implementation. Deferred loan fees are not considered in determining the amount of pre-implementation debt. So this is a specific question in the Q&A. And the example was, so if you refinance and your pre-implementation debt does not change, but you incur deferred loan fees, that is not an increase in the debt. What the department said, that's a fee for refinancing, but that does not taint it. So that was actually a positive ruling by ED. I think they're saying the debt didn't change. It's just the cost of going through the refinancing, which is a normal business activity. And deferred loan fees are excluded in the CSR calculation. They don't go into any of the numbers. So you're using debt gross, not net of deferred loan fees. Big thing to think about is acquisition debt. When acquisitions occur, that debt is to buy, many cases, the stock of a company. That is not for PP&E. So all that debt you can no longer be used in your composite score ratio, depending, especially after, from now forward. If you do an asset acquisition, I think some argument could be made that some of that debt is specifically for the PP&E acquired. But as you know, fixed assets compared to the overall acquisition price is usually fairly low. And so this is something that has to be worked through. But I think, debt and acquisitions may no longer get, most of it will have a benefit, will not have a beneficial treatment, and could have a really major impact on passing the composite score post-acquisition based upon the goodwill and the intangibles in that acquisition. So again, planning has to be done, long ahead of time to figure out what the impact's going to be. So I've gone through a lot, and I know a lot of it today is just high level, just to let you know and kind of understand what these regulations have. Department's now going to need a mechanism to track this information, right? You've got pre and post PP&E, pre and post implementation debt. You've got lease standard in a couple of years, pre and post implementation. So what are they going to do? So they're now adding a new supplemental schedule that is part of the audit. It has to go in every school. Doesn't matter, for-profit, nonprofit, has to be included. And Easy Audit has now been changed, so the input screens on Easy Audit will align to the supplemental schedule, so the composite score can be calculated when Easy Audit is entered. The supplemental schedule also has to refer back to the audited financial statements or the footnotes. It has to point to where you're getting the numbers so the department can understand the classifications of leases and debt and PP&E and other numbers, so they can look at it and say, yeah, do we agree with your treatment? I highly encourage all of you to go through the Appendix A and Appendix B in the Bar Defense Repayment Regulations. Appendix A is for for-profit, and Appendix B is for nonprofit schools. It goes through examples in there. It shows you how in theory, how the calculation is supposed to work. We do have a couple of questions on the appendix. We're waiting to hear from ED on. But I think it shows you how kind of involved the calculations are now. So if you're going to be talking to your auditors on it, it's helpful to look at that and see where they're coming from and to realize the components that are needed. So some of the new components, as I talked about, again, this is not all-inclusive list, but some of the new items, we showed you our old composite score template. And the reason we said that specifically is the old template, because here's some of the things that are on the new template. Pre-implementation PP&E, pre-implementation qualified debt, post-implementation PP&E with debt, and post-implementation PP&E finance with, not finance with debt, post-implementation qualified and non-qualified debt. And you need depreciation expense broken out between pre-implementation and post-implementation PP&E. And that's something that normally doesn't come right from the financial statements. I mean, we've had to go back to work papers to pull that number. Again, there's a lot here on the supplemental schedule. So we're going to walk through a couple examples. We're not showing the entire supplemental schedule, but we're going to show two examples of how the debt may change and what the impact is on the primary reserve ratio. So let's take an example. You have $10 million of debt, and that was your pre-implementation debt. The department accepted the statements, and you paid off $5.5 million in the current year. You took on new long-term debt of $2 million. So that's now your post-implementation debt, and you utilized $1.1 million of that for PP&E in the current year. And we can tie that. We say it was specifically for that PP&E. And then your PP&E, your pre-implementation was $11 million. Your post-implementation PP&E was the $1.1 million, as we mentioned above. And there's your depreciation numbers. Total of $1.5 million. 1.475 was for your assets at 12/31/19 and $25,000 for the assets you bought in 2020. So this is what, at least in our supplemental schedule, what we're calling Note C, composite score ratio Note C. We're starting with our $10 million of our debt from our last audit and subtracting the $5.5 million to get $4.5 million. So that's our pre-implementation debt that still is qualified because it didn't go up. We got $1.1 million in the current year that we used debt to pay for, and we bought another $900,000 that we just paid from operations. So there's no debt for that $900,000, which means I've got total debt of $6.5 million. Now I come down to my assets. We had $11 million of assets last year, and we took off $1.475 million for depreciation. So there is our net PP&E pre-implementation, $9.5 million. And then we added on $1.075 million. That's the $1 million of PP&E this year, less the $25,000 of depreciation to get $10,600,000, which now is our total PP&E. So if we go to the next slide, we look at the composite score ratio. We've made a few assumptions here. We've just assumed equity is $8 million, goodwill is $1.5 million. I've put right to use assets in here of $1.5 million and a lease liability of $1.5 million, which just offset. We take out our 10,600,000. All of our PP&E comes out. 10,600,000 comes out. We add back 4.5 million of our pre-implementation debt. We add back the 1,075,000 of post-implementation debt, and we get a composite. We get the primary reserve ratio score of 0.632. Remember, the max you can get is 0.9 on this score. So it's still a fairly high score. Again, you can see why the supplemental schedule is now needed, because department picking these numbers up from your audit financial statements is not going to be possible by just looking at the balance sheet. So if we go to example 2, all of the facts are the same. Bullet point 1 and 3 are exactly the same. The difference is bullet point 2, that you've got a new long-term line of credit of $1 million and long-term debt of $1 million. So it's still this. So we have $2 million total, but we didn't use any of that for PP&E. We've used it all for operations. We can't. Let's say it's restricted. It wasn't allowed for PP&E, so we're not going to have any, qualified post-implementation debt. So if you go to example 2, you'll see. So here's the composite score ratio. You'll see we still have 4.5 million of pre-implementation debt. That doesn't change. The 10 million less the 5.5. You'll see here the middle lines are different. We now have $1 million in post-implementation long-term debt not used for long-term capital, and $1 million of post-implementation long-term line of credit, not used for long-term capital investments. So our total debt is still 6.5 million, but we've got nothing up here in the allowable post-implementation debt section. Our PP&E is the same. We're still at the 10.6 million with exactly the same factors as example 1. The issue now is when you come over to look at the primary reserve ratio, you'll see the 8 million goodwill and the the 8 million equity and the 1.5 million goodwill are the same. The right to use asset and lease liability are the same. We subtract 10.6 million for PP&E. We add back 4.5 million for pre-implementation debt, but there is no allowable post-implementation debt. The 1,075,000 is gone because it's no longer qualified. That drops the primary reserve score to 0.17, which is a change of 0.461. And so as an example, our entire composite score just went down by 0.5. So depending what happens to your debt, and you layer that on with the lease change that's coming in, albeit still a couple years away, you could, if you're not planning properly, you could start looking at changes, depending on what your debt is, significant changes to your composite score ratio based on what your debt structure is and how that debt may change and what you're using that debt for. So this is where it becomes really important to be modeling these numbers, not just before year end, but before you're making changes to your financing and the debt levels of your institution. And as you can see, these changes aren't easy to do in the back of an envelope, that you've really not got to run through them, drop them in the model to be certain you're 100% correct. And I'm going to turn it back there now. We're going to come back to the supplemental schedule again in the planning sections, a couple things to know. Jen's going to talk about the CARES Act relief, and this does tie in because the PPP and the HEERF could potentially impact your composite score in a positive way. So it's one of the factors to consider as the composite score changes are occurring.
Okay, so this is the last main topic of the day, the accounting and recognition for the CARES Act funding. So we are going to go over the PPP loan funding, as well as the HEERF grants, which would include the student and institutional portion. So the CARES Act allows for the accounting standards allows 3 different standards to be followed for the CARES Act funding. The first standard that is referenced is ASC 470, and the topic that's covered here is debt. This would apply or can be applied for the PPP loan. So key points of this particular standard is that an institution would record the PPP loan as a liability on the balance sheet and then also accrue for interest on that liability. The forgiveness of the debt would not be recorded as a gain until that loan is forgiven. So that could be further on down the line. And the threshold for that forgiveness and the recognition of it is legally forgiven. And that's spelled out in that standard. And the last thing to note as a key point for this particular ASC is that on the balance sheet, loan would be recorded as the short-term amount and a long-term portion if you have a classified balance sheet, that is. The next standard is ASC 958, and this is typically a standard that would only apply for nonprofit entities. The accounting standards do not have a standard that's specific to government grants to commercial businesses, so the codification allows you to look to other standards, and this is one of them. So the topic here is grants, and it would apply to the HEERF grants, as well as potentially the PPP loan. The key points for this standard is that the HEERF and the PPP are looked at as a conditional grant. So if these items are not used, they basically have to be returned to the department. And then there are certain barriers or costs or things that they have to follow in order to get to apply these funding amounts. So they have to follow the instructions and the guidelines for the funding. Revenue would be recognized when these particular conditions are met, and they would be continually reassessed to ensure those conditions still exist to be met. Revenue and expense are recorded gross under this particular state standard on the income statement. And the last standard that is referenced or can be referenced is IAS 20. This is an international accounting standard, but as mentioned before, can be followed since specific guidance does not exist for government grants to business entities. This would apply to the PPP loan as well as HEERF. And it's similar to ASC in the sense that the revenue recognition piece. Certain conditions have to be reasonably assured that they are met. So the revenue recognition will be over time consistent with the expenses. The difference between IAS 20 and ASC 958 is that the revenue and expenses can be offset on, net or gross on the income statement. And this is a summary slide. Since we went through those items quickly, this is a good guideline to say a nonprofit institution for the HEERF grants, you must follow ASC 958. For the PPP loan, you can follow ASC 470 or 958. The for-profit institutions for HEERF grants can follow ASC 958 and IAS 20. And then for the PPP loan, they have all three standards as an option. So there's a little bit of flexibility here for institutions. So I would go back to the previous slides and look at those key points. Determine what is allowed to be applied for your institution and what would be best for your institution.
And Jen, when you were talking about, let's go back just one slide. When you were talking about the conditions on the grants, say if you're following 958 or IAS 20, what we've seen is thinking through your HEERF grants, as you utilize those funds, whether you draw them down or not, you've determined that you've expended them. So you've just put up your first disclosure as of September 30th. And obviously you're going to put one up on January 10th for your your fourth quarter of 2020. So if you're a December year end, those amounts that you've claimed, at that point could be recognized as revenue on your statements because you've said, I'm entitled to this funding, and either you've drawn down the money or you have a receivable because you're going to draw down the money in 2021. And so that, so to us, the barriers and conditions have been overcome when you've determined those expenses are valid, the expenditures have been made. Items that we've talked about in our HEERF accounting, which are HEERF reporting, that are gray, that you're waiting for Ed's guidance on, I'd say those things you wouldn't recognize as revenue yet because you don't know if you're going to utilize funds for them as not, is what we've seen schools doing. And I would not worry if you haven't made the entries monthly. We don't think that's a big deal. You can make those entries as part of your year-end close or quarterly whenever you think that the time is reasonable to make them. And I'd say, Jen, from our perspective, correct me, we haven't seen, for a for-profit school, they've pretty much been following 470 or IAS 20, just because it's a little more beneficial than following 958. The nonprofits we worked with have had to follow 958 for the HEERF grant, so correct?
Yep.
Okay. So the last thing we wanted to talk about was just kind of going through some financial statement planning, things to think about for both the CSR and the CARES Act. Some of this I've alluded to a little bit was considering the lease impact. Are they structured? How are they structured? Can you change the length of your leases? Can you start computing a projected composite score now in advance of the lease effective date? I've had some clients already starting to contact us as they're renewing leases to see what the impact will be. Don't wait. The advantage here is the standard's not coming in for 2 years. And so unlike the debt changes in the composite score, you do have a little bit of time to look at it. We had done an article before in Career about lease strategies to maybe how can you keep the right to use asset from getting too big. If you can make it a little smaller by taking certain steps, then that's advantageous to you. Start looking at debt. Start looking at your current debt now, whether it's pre or post implementation. Look at assets you've acquired during the year. Do they have debt that's existing or not? Considering if you want to borrow or lease for all your equipment, if you have to make a tie-in for your new additions, is it easier just to do capital leases? As I just said, all your leases are going to go on your balance sheet anyways. So whether it's, so if you just do capital leases, they're going to end up there in 2 years if you do operating leases. But by having, capital leases, it's a very clearly distinction to say this capital lease was for this equipment. And so that tie-in will be very, very easy. And there's no detrimental impact now of recording a capital lease, at least not in 2 years, when all your leases will be recorded. So I think those are things to think about. We do have a supplemental schedule that it's not one of the things we're providing today. That is something that's part of our audits that we're doing with our clients, and it's something we will work through the supplemental schedule with someone on the consultant services. But we spend a lot of time and effort developing that, and it's going to our audit clients. So it's not something we're just giving away, but we are available for a consulting service to walk through your specifics. And at that point, obviously, would turn the supplemental schedule over to you once the project is completed. And then thinking through your audited financial statements, be certain your auditor is on board, especially if you're using an auditor that doesn't do a lot of work in the industry. They need to be very aware of the supplemental schedule and the changes, because what the Bar Defense of Repayment regulations does say that for obviously your pre-implementation PP&E and debt, those are known numbers. So they're coming from the financial statements. You don't have to do anything else but memorialize them in the supplemental schedule. But for your new post-implementation PP&E and debt, you have to tie it together. So what you have to do is if you have debt that you want to treat as qualified and it's long-term, is to tie it to the PP&E. So you've got to show beginning and ending balances of the debt, the principal payments, the repayment schedule. If there's other changes in the legal agreement, just saying this is what changed during the year, and exactly what PP&E that qualified debt was used for. So you've got to describe this stuff in the footnotes. Much of this is already there, but I think the tie into exactly what PP&E was used is certainly something that's new. So whether you're building a new location, you use it for equipment, you've got to say this debt was used for this purpose. And then depending on how much pre and post debt and PP&E you have, you can put it right in the footnotes. Maybe you create a new chart in the footnotes if there's lots of debt, just to make of, here's our pre-debt and here's my post-debt. I mean, I think it depends on each audit and what is already in your audited financial statements, but you need to be thinking through that. And eventually leases. There will be, in 2 years, there will be a lease footnote that's required by the accounting standards that you're going to have a lot of information in. And in that footnote, you're going to have to describe what are any pre and post implementation leases for the department ed as well. So it ties into the supplemental schedule. Or for those of you who are public institutions or nonprofits with public conduit debt, that lease standard is effective for you now. So it's obviously things you're going to have to be working into your financial statements. Again, so lots here that your advisors are looking at in advance of year end.
So moving on for the next steps related to the CARES funding. For PPP, we've generally seen ASC 470 being followed. So that's the standard where a liability is recorded and then there's a gain recognition later when the debt is forgiven. But like we said before, there are options to follow ASC 958 or IAS 20, depending on what type of entity you have. So you may want to look at those two standards because ASC 958 and IAS 20 would allow you to recognize revenue in advance of that forgiveness, as long as the criteria are met or the conditions. And most likely with PPP, a lot of that funding is payroll. By the end of the year, 12/31, those conditions most likely would be met. One thing to note, though, the department allowed for relief related to the composite score for the PPP loan. If it is recorded as debt, it could be treated as equity and not debt as long as an auditor would attest to the forgiveness amount. In no way did the department define how that would be done, but within the audit, there will be a new supplemental schedule. So if that forgiveness is audited as part of that schedule, then that could be a way to attest to that amount.
And Jen, I think I'd say, and one thought as well is, if your composite score is going to be passed and you don't need the PPP loan included in any event, then maybe it's easier to leave it as debt. Don't put in the supplemental schedule because you don't need it, because there's still a lot of push to find out what's the ultimate tax treatment going to be for the PPP loan for those expenses, which are right now not deductible, and the PPP loan is not taxable as income. So if you can just leave it as debt and wait one more year to see what all pans out, that's probably the best way to do if you don't need it in the CSR. And the SBA has extended the repayment dates. I may be quoting this wrong, but I think it might be 10 months from the end of your either 8 or 24-week period. So that repayment, the original repayment period is later than what was thought this spring. So you have additional time. So we're thinking, if you can just kick it down the road 1 year, it's the best way to go at this point.
Yeah, and I would just add real quickly that the benefit of that is you get to pick up the net income ratio component of the composite score. So if you take it during the current time frame, you get the equity boost, but it doesn't get recorded in the net income ratio for this year.
Yep. Under the ED relief provision.
Under the ED relief provision, right.
Yeah, so you may want to model the treatments to see what would be beneficial, looking at current year results and then what does the plan yield for future years. And then lastly, for the HEERF grants, we've seen for-profit institutions generally follow IAS 20, and that's because of flexibility of reporting revenue and expenses gross. It does impact the composite score. I'm sorry, reporting it net, not gross. Reporting it gross would have a small impact to the composite score that would have it lower. It'd be very minor. So the option to report it net would be good for the composite score. You'd have a better ratio. So no matter what treatment is elected for the HEERF grants or even the PPP, what's important is really that the standards are applied appropriately and that the information is disclosed clearly in the financial statements. So I just wanted to make sure that's a key takeaway point for institutions when you're looking at these three standards and trying to make decisions on how to record and account for it. Whatever is decided, make sure that's very clear for the regulators, for the banks, whoever may be looking at your financials. So we have reached the end of our presentation. Was there anything you wanted to add, Mike, or are we ready to go to the Q&A session?
I think I'll just reiterate just a couple items. I know we went through a lot of information fast and we're just trying to get some of the highlights to you, but just the importance of looking at the appendix for the supplemental schedule and really make sure you understand it, and going through it in advance of year end, and going through the Q&A if you've made changes to debt or if you're thinking about it, because it really could have an impact. And if you haven't planned for it, you could have a trip up if you're computing these ratios after year end. So planning is always important, and it's even more critical this year. Again, there are some HEERF and PPP options. So if there is some of those missed or because of COVID, your ratios are down, we've got some options under the PPP and HEERF grants to help the schools beneficially as well. But I think you want to try to do this before year end and not wait till your auditors arrive next year, because it could be your options of changes may be a little reduced.
Okay, so now we're going to go back to Dave for the questions that we've received.
Thanks for covering for me. I was flying through there on mute, not helping anybody at all. Thanks, Jennifer and Mike. Great job for the guidance. We did receive several questions, and we'll attempt to answer as many as possible. Just note, if we are unable to answer your question or you have follow-up questions, we just ask you to reach out to us directly. We're happy to offer any assistance that we can. So a lot of the questions we have right now, I would say, are tied to the lease standard and how the leases need to be treated. And to start, it might be for a lease that has options, how are the options treated in calculating the right to use asset?
I have to go back and look at the Q&A. I know exactly how the because I've looked a little closer to the debt than compared to the leases at this point. I believe that the options, if the options are renewed after 12/15/18, I believe then it becomes a post-implementation lease. We can certainly verify that. And I believe one of the questions in the Q&A was in there, if someone decided to record all of their leases, put all their leases on their balance sheet, including extensions, you could do that before the standard came out. But I think if you're making those changes afterwards, I think they might be post-implementation leases. But I can check the Q&A and get back to you with certainty, because it was a specific item in there.
And I think the flip side, there was not guidance about exactly do they have to be included if there are options. I mean, obviously you have to be considering how likely they are to be for the lease to be extended, but that's something you should be working on with your auditor and working through that, I would say.
So outside of the composite score impact, just purely from an accounting and reporting perspective, under the new standard for private entities that should be implemented year-end December 31st, 2022, when determining that lease asset and lease liability number, it would be the lease as it exists, as well as any reassured extension periods. So that's just something to address just the general accounting and how that asset and liability number would be determined. So there could be, if there's a difference between that composite score specific pre and post, there may have to be a reconciliation at some point.
And Dave, I thinking back to what I was saying, I believe how the Q&A says is if you put a pre-implementation, if you put a lease on your balance sheet but it occurred before 12/15/18, when you renew and extend that after 12/15/18, it stays pre-implementation. But if it's not on your balance sheet and you renew and extend it, and then it becomes a post-implementation lease, that would be included. Again, the problem is most people haven't recorded the lease on their balance sheet, and now we're past 12/15/18. Remember, these rules came out in September of 2019. And how they grandfathered the leases and the debt was not what was in the unofficial rules, or the proposed rules from August of 18. And so the problem was, by the time these rules came out, there was almost no changes you could do for some of the leases because you were past 12/15/18 already. That's what was kind of frustrating about them.
A somewhat similar question. What if my lease is month to month? Does that have an impact on my composite score?
So I'd say right now, that's one of the things we're still monitoring. Department will follow GAAP accounting, so whatever the auditors say. And I think one of the things, as Jen alluded to with options, it's still very unclear in the accounting guidance what you do with related parties. Is it truly a month-to-month form, or is it substance over form? And you say, listen, you can't have a month-to-month. You have to assume there's some life associated with that. And there's been almost no guidance on related party leases. And we're hoping the accounting standards still kind of address that. At this point in time, we're thinking that they may not be on the balance sheet, but it's still not 100% certain. And it's an area we keep watching for more guidance, but little has come of it. Now, so I think that's going to be driven by what GAAP says, not ED. They'll follow whatever the GAAP treatment is.
And what I've read is some of the interpretations go back to what is legally enforceable. So doing an assessment on that. Is there a signed document? Can a party be taken to court, even if it is related party, over the transaction?
Okay, thank you both. Next question is, if we have a PPP loan and have filed a forgiveness application, but no decision has been made on the forgiveness, will there be an impact on our composite score?
You want to take that one, Jen?
Sure. So when we went through the various options for the accounting treatment, I would say, yes, there's an impact to the composite score based on which ASC that you follow. In addition to the department allowing, if the treatment of the ASC 470, to treat that like a loan, allowing for that change of putting that number in equity as opposed to a liability. So yes, there is an impact, I would say more so driven by the standard selected than potentially the department's modification for the PPP loan. So it's just really going back and trying to, I would say, project what the calculation would be under the various scenarios.
Yeah, if you treat it as debt, the liability is not forgiven until you legally get the forgiveness. So in that case, you may not get the forgiveness to 2021. If you treat it as a grant and you believe you've earned it, there's a basis to record the revenue. So you do it in 2020. So excluding the department's relief they've provided, that's kind of the two options to think of and to figure out in your situation, do you need the revenue this year and what's the best course to take?
Right. And I think when I read the question, I was also thinking in consideration of the long-term debt, which the debt portion in either instance doesn't get considered as part of the composite score, the add back.
Correct. And that's a good point. Yeah, the PPP loan is clearly not used for property, plant, and equipment. So there is no benefit in the composite score ratio, which makes sense. It was strictly for wages. It was a true definition of operations.
All right, and the last question we have is, we have several facility leases that have amendments in 2020 that allowed us to delay 3 months of payments and spread them across all 12 months in 2021. do these amendments take the lease out of the grandfather category? So it seems like the landlord obviously provided some relief due to COVID to a tenant.
Jen, I'll answer and then you could chime in. I know you've looked at some of this. I know the accounting standards have provided relief due to modifications due to COVID. And depending on how big the concessions are, you don't have to go back and necessarily reassess the leases. And so on the surface, I'm thinking just because you got those modifications may not taint them as pre-implementation leases. But I think that's a very specific question that would need to go through the facts and circumstances in it and see how big the concessions were, is my initial take.
I agree, Mike, with what you're saying. And if the amendment is not changing the total cost and it's just a shifting of when the payment is made, that change may not be material, and it's not changing those original inputs of the lease.
I think I make an argument that if it's not a change under GAAP for modifications, is because of the COVID crisis, it seems to be an argument could be made to ED then that if it's not triggering any substantial change for GAAP, then it shouldn't for the pre and post implementation lease either, especially in light of the pandemic. That would be the argument I would make if possible. So, but those examples could be gone through and to see how it pans out.
All right. At this point, we've reached the end of the webinar. Jennifer, Mike, thanks again for sharing your thoughts with us today. As I mentioned earlier, we will be sharing a recording of today's session, so you will be able to re-listen to it at any point. Everything on your screen today will also be available for the recording. And in closing, just thank you for your participation and for all that you continue to do to help students. Have a great afternoon.